Michael Burry is famous for his huge shorts, but he'll be remembered for the massive short too. Burry is now betting on the greatest financial disaster in the history of the United States. Yes, we're talking about a crash worse than the 2008 recession, the dot-com boom, the Great Depression, and the Great Inflation. Burry is expected to be the father of all crashes, accompanied by the greatest drop in corporate earnings. Within the next few months, the world will awaken to this issue, and Burry will once again earn billions. Hey there! Welcome to yet again another video of Investing Wise Academy. This is Fred, and let's get right into it. The previous 13 years were the longest bull market in US history. Since 2008, the value of the S&P 500 has climbed by more than 6 times. This exceptional price increase was compensated for by rising responsibilities. Since 2009, the overall public debt has more than quadrupled to more than $30 trillion. While it's hard to determine how much debt is too much, accumulating trillions of dollars in debt every year is unsustainable. The rising debt level is accompanied by a precipitous drop in consumer savings. The personal savings rate in the United States is now at levels not seen since 2008. Despite inflation, overall personal savings have fallen to levels not seen in nearly a decade. It is quite disturbing that overall savings are dropping while billions of dollars are being added to the economy. To make matters worse, credit card debt is an all-time high, indicating that the consumer is becoming weaker by the day. Michael Burry tweeted that U.S. personal savings fell to 2013 levels, the saving rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak despite all those trillions of dollars of cash drops in their laps, looming a consumer recession and more earnings trouble. As the economy operates on a circular cycle, a weakened consumer has a direct influence on company sales. Businesses and consumers deal in the manufacturing market by trading labor for revenue. The product market is the inverse of this. When households buy things from which corporations earn because families have less purchasing power, the product market will suffer decreased activity. Decreased product consumption will result in lower business earnings. Lower corporate earnings will cause the factor market to deteriorate, reducing household income and thus hurting the goods market. This is a positive feedback loop because a single negative occurrence can start an unending downward cycle. Economists refer to this as the circular flow model since economic calamities at any point in the cycle are infectious. Consider the circular flow concept to be like pouring one drop of food coloring into a pail of water. The entire bucket of water will be colored in a couple of seconds. Burry provides quantifiable evidence on why a drop in consumer sentiment will lead to a slump. The rationale for this is that low consumer activity will reduce business profitability, lowering household income and resulting in even fewer savings. Burry reaffirmed his remark by demonstrating the declining tendency of U.S. personal savings to GDP. Charting total U.S. personal savings GDP redline has the all-time low at 1.5% set in July 2005, and the last 12 months rate of depletion of savings could hit that level between September and December this year, borrowing time. A graph indicating a cyclical drop in the personal savings to GDP ratio is attached to the tweet. Burry is advocating for a consumer-led recession, but he is not alone. In 2019, Federal Reserve Chairman Jerome Powell expressed concern about the expanding national debt. The overall U.S. debt at the time was around $22 trillion. That figure has already risen to more than $30 trillion, a 36% growth in 3.5 years. All of this is frightening, But you may be asking what level of collapse we are discussing. Leading economists throughout the world frequently relate our current position to that of the 1970s, when the United States faced double-digit inflation. The 1970s are typically seen as a time of stagflation since the economy endured both high unemployment and high inflation. Due to limited consumer spending power, this era corresponded with a record spike in the misery index. Consider a moment in which you are not only unemployed, but your money is also worthless. That may appear alarming, but Burry feels that our current predicament is orders of magnitude worse than the 1970s. Michael Burry stated that some compared the US of today to the 1970s, but the 1970s saw rapidly growing labor force participation due to the post-World War II baby boom. We have the opposite today birth rates at 1950 levels and nuclear families and 1959 levels despite a 2 times larger population don't help. Burry refers to our current scenario as the polar opposite of the 1970s for 2 reasons: the birth rate and the labor force participation rate. The 1950s are regarded as the baby boom era because fertility rates skyrocketed. This significantly enlarged the workforce, allowing for increasing economic activity in the 1970s. Add to it a substantial growth in labor force participation, and the situation wasn't as dire as it appeared. Our current situation is the polar reverse of this. Despite having a population that is double that of the 1970s, we have a birth rate that is half that of the 1950s. Not only that, but the labor force participation rate has been steadily declining due to widespread resignation. The Great Resignation was a time that began in the spring of 2021, when a massive inflow of American employees began abandoning their employment. Low compensation, poor career chances, disrespect, and a variety of other factors contributed to these resignations. So the 1970s were a terrible time with a lot of social upheavals. But picture what would happen in 2022 if we have stagflation as well as a really poor labor market. Burry tweeted an article, "The parallels between the 2020s and the 1970s grow more numerous by the day. The economy faces the threat of stagflation, fuel prices are surging, and shortages loom. Politicians are flailing, the international environment is deteriorating. The Supreme Court is revisiting the 1973 Roe v. Wade ruling. The homicide rate is soaring amid a general sense of social breakdown." While Burry was kidding about Slipknot's music videos, he tweeted, "Starting shooting the generals in September 2000, January 2008, and April 2022. And he feels our present bubble is the mother of all bubbles." In late 2021, he tweeted about how we have more speculation than the 1920s, more overvaluation than the 1990s, more geopolitical and economic strife than the 1970s, players grabbing the barrel of Kyle Rittenhouse rifle while the at SecGov and at Federal Reserve not approvingly. In addition to noting the similarities with other disasters, Burry also openly referred to the present bubble as the greatest speculative bubble of all times in all things, by 2 orders of magnitude. Although the economy is in a bad state, a powerful government can aid in the alleviation of various economic and social difficulties. President Joe Biden has not been like this. The great majority of economists have expressed concern about how Biden has exacerbated government debt problems through excessive fiscal expenditure. Biden's budget was $5.8 trillion, accounting for more than a quarter of the total U.S. GDP. This amount of expenditure during an inflationary environment will only exacerbate our current problem. Burry expressed his displeasure with Biden's budgetary expenditures by saying, "Wishing a real potato was president." Some may argue that the dollar index is rising, implying that the U.S. currency is in good shape. The dollar index Economics, on the other hand, compares the US dollar to other fiat currencies. Fiat currencies are supported by the government, such as the Chinese yuan or Russian rubles. Comparing to the US dollar to other international paper currencies is pointless since we are in a worldwide crisis. He also warned about this by saying, "When you see mention of the strong dollar, the almighty dollar, please remember this is only in relation to other fiat currencies. The dollar is not at all strong and it is not getting stronger. We all see it every single day in crisis of everything." In other words, the US dollar is becoming more valuable in contrast to other fiat currencies. However, when compared to actual things, the dollar is weakening by the day. Michael Burry's macroeconomic thesis is straightforward. However, few people will heed his warnings. Warren Buffett was one investor who did not listen to Burry before the 2008 crash. Buffett then expressed sorrow and declared publicly that he should have investigated Burry's notion. Michael Burry believes this will happen again and tweeted a video in which Buffett refers to him as Cassandra. In Greek mythology, Cassandra is a Trojan priestess who made genuine prophecies that no one believed. Buffett referred to Burry as Cassandra because he was presenting an accurate forecast that everyone ignored.
Congress, but don't we expect referees to make the call?
Yeah, we expect
even if they're going to
yeah.
get booed?
Yeah, and they made the wrong call. I mean, they basically believed, as most of the American public did, and you couldn't have had this size bubble without overwhelming. And the Cassandras were there, but who was going to listen to John Paulson in 2005 or 2006 or Michael Burry? I mean, it didn't mean anything.
Burry had wagers against the market that allowed him to make billions during the 2008 crisis, and he still does. Burry does profit from market crashes, but he does not like doing so. As I said about 2008, it is like watching a plane crash. It hurts, it is not fun, and I'm not smiling. So, we now know that Burry is forecasting a massive market meltdown that might lead to the Big Short too. However, how can he profit from the impending market crash? According to his SEC filings, he is acquiring shares in stable inflationary-resistant firms. This includes a $20 million investment in Bristol Myers, an $18 million investment in both Facebook and Google shares, and several other firms in a similarly strong position. A strong moat and significant pricing power are two fundamental commonalities between these organizations. These firms will be able to boost prices during an inflationary environment while crushing their competition if they have both of these criteria. Burry also just stated that he had a $35 million put option on Apple shares. This is most likely a hedge against his positions on Facebook and Google. Apple will incur rising material prices, but Facebook and Google will not. But more crucially, Burry is expected to have a significant short position in the bond market, which he is not required to reveal to the public. Michael Burry is once again constructing his portfolio for massive profits in the coming months, and he may make billions again. Let me know what you think of Burry in the comments below. How are you planning for a market crash? If you like this video, please like and subscribe, and I'll see you in the next one. Again, this is Fred, and see you on the next one.